this is loanable funds with supply of loanable funds, demand of loanable funds, and also the demand of bonds and supply of bonds at equilibrium. Okay, remember they're all supply and demand graphs, just they have different labels. So we're going to start off. If we're adding investment demand, remember we're going to have both of our graphs like this. Let me zoom in a little bit since we're just focusing on this one. All right, so loanable funds are the deposits that we put into banks. That's why they offer free student checking, free ATMs. They need your money. They need your money so they can loan it out and charge interest on it. So, the supply of loanable funds, that is us putting our money in it, into the bank. Okay? The supply of loanable funds means that money is there so we can go borrow it. They're loanable. That's what the bank wants to do with it. So if you want to borrow money, then you need to go to the bank and ask for it, don't you? Apply for it, they run your credit, all that. Okay? So supply of loanable funds is also the demand for bonds. So I'm going to put D bonds. Okay? Now, people who want to borrow money, they are the demanders of loanable funds. As well, governments or corporations, they need to borrow money, so they will print bonds, they will supply them. So if you want to borrow money, you have demand for loanable funds in the bank. If you want to borrow money, you print bonds as a corporation. So that is the supply of bonds. Now, banks have a job to know how to make a profit. If you want to make a profit, you need to understand inflation. So, if you guys want to be a business major and go work at a big bank and you're good at crunching numbers, they will say, okay, well, inflation is 2%, the interest rate is 5%. What do you think the interest rate will be for the next 30 years, which is the life of this mortgage we're about to lend out? So here's $200,000 for a house at 5%. Here's the scale of inflation for the next 30 years. What is our profit on the 4,000 mortgages we have at 5% at this credit rating? And then you take everyone's income to debt ratio and you start to do all these programs of figuring out how profitable that bank will be for a while. Then all that goes into the bank's financials. Then people can invest in the bank by buying stock in them and so on. So those jobs do exist. Okay? So banks need to know what the real interest rate is. So at the real interest rate, there is a certain quantity of loanable funds that are out there. So our quantity of loanable funds is on the x-axis. So that amount of loanable funds, basically it's kind of like a consumer price index at this point. When people borrow money at a certain credit rating, it will be at a certain rate of interest. So banks can know how many people will come borrow at 5% or how many people won't borrow at 6%. So that will establish our relationship to investment demand and therefore gross private investment. So I'm going to match my interest rate of the investment demand curve. I'm going to bounce that level of interest off of the investment demand curve. And so now I have a certain amount of investment at a certain interest rate. So now if money is added to the loanable funds market or taken away, then that will alter those loanable funds and therefore the real interest rate. So I know what I'm going to add to the next one. I'm going to add the real interest rate. So real interest rate is equal to the nominal interest rate minus inflation. So R equals I minus pi. Now, once we have investment, by altering interest rates, then we'll know how much investment can change GDP. Just like that last question you had. $2 billion worth of more investment spending really will equal 8 million, won't it? If we know our multipliers. So our multiplier is 1 over MPS or 1 over 1 minus MPC.